We are live. Hi, everybody. Welcome to our stream. We're going to wait a couple more minutes and then get things started. Thanks for your patience. Okay, I think we are slowly getting ready to get started. Let me turn off our captions. GM, OpenCover, happy to see you here. Okay. Hello and welcome to our last session of the first cohort of the DeFi Risk Learning Group. I hope you are having a wonderful summer from wherever you are listening us from. We cover recent news in DeFi, dive into the fundamentals, and explore what's happening right now. All the while, we keep an eye on how to stay safe in DeFi. Today, we are wrapping up the first cohort. We've got Hugh, hopefully Brave from the Nexus Mutual team, and Jonah and David from the learning group with us today. Welcome, everyone, and again, a warm welcome to all our listeners. Before we jump into today's call, I want to take a moment to recap what the DeFi Risk Learning Group was all about. Like I mentioned, this is the last session of the first cohort. The DeFi Risk Learning Group, also known as DRLG, was our very first peer-to-peer learning cohort designed to help curious minds dive into decentralized finance and risk management. We explored key use cases in DeFi and why they matter, not just financially, but also as a piece of social infrastructure. Along the way, we focused on understanding and managing blockchain risk. Big thanks to everyone who took part, especially David, Jonah, J0C, Luca, and others for joining us in this experiment. If you missed out, don't worry. We are planning a new cohort for autumn, which I will share more about through the end. All materials will be public again, so even if you can't join the program live, you can still follow along. To learn more or to express interest, please sign up at Nexus Mutual DAO, nexusmutual.dao/risk-group. All right, here's what's on the agenda today. First, we'll hear from David and Jonah, who successfully completed this cohort. Congratulations, by the way, and ran some DeFi experiments for us. We'll ask a few questions and hear about how it went. Their insights might be especially useful for anyone thinking about dipping their toes into DeFi for the first time while staying protected through Nexus Mutual's risk sharing ecosystem. Then we'll hear it from the team. Hugh will probably will be the one instead of Bray today, who will walk us through some lessons learned from Nexus Mutual's claims history. Since 2019, we've paid out over $18 million in claims, and we're proud to have supported users during those critical moments. Claims assessment is one of the most asked about parts of what we do, so I hope this section will shed some light on those questions as well. After that, Hugh will share what's next for Nexus Mutual. We are in a period of strong growth and are doubling down on the steps we need to take to prepare for what's ahead, both for the mutual and the broader industry. Hugh recently posted some of these plans on our forum at forum.nexusmutual.io, and we'll highlight a few of them here as well. Tune in, you might get inspired. Last but not least, I'll touch briefly on what's coming up for the DeFi and Risk Learning Group Cohort 2 and share a few next steps. After this long introduction, let's dive into today's topic number 1. Okay, to encourage participants in this learning group to experiment with DeFi, we offered a small stipend to those who expressed interest. Everyone came in with different levels of experience, and we provided a few pointers to help them get started. First thing we did, we asked them to choose one of the protocols included in Nexus Mutual's Essential Cover. This cover allows users to protect assets across a portfolio of protocols with just one cover purchase. Some of the included protocols in Essential Cover are Aave v3, Aerodrome, Pendle, and many more. I think it's more than 70 protocols that are covered within Essential Cover. Participants researched a protocol, deposited funds, and interacted with the dApp on their own. They also shared notes and made notes on user experience and accessibility of the dApp. As the final step, they purchased cover using either the Nexus Mutual UI on the mainnet or through OpenCover on one of the layer 2s. We also requested them to make note of any feedback they had for us or for OpenCover. All right, to kick things off, I want to ask David and Jonah, which decentralized apps did you interact with as part of this experiment, and why did you choose them? David, let's start with you.
Hey, hi. So I chose Morpho on base. So the first reason is that I think it has a very good reference. Second reason is why I didn't test it before directly. I tested it through Bifi, but not on their UI. And lastly, I didn't use DeFi for some time, actually, for more than 6 months. So I wanted to go again with the yields where they are better on Bifi, on DeFi Llama, and also on Bifi actually. And I filtered with big pools, more than 1 million or 10 million TVL, and I found that the bigger yield was on Morpho. And so yeah, essentially that's how I chose Morpho.
Nice, kudos for using a tool like DeFi Llama and actually having some filtering criteria of your own. I think that's a really nice way to replicate for some of the DeFi enthusiasts out there. Jonah, over to you. Which dApp did you use and why?
So I used quite a few different ones when I did it. I tried first. I tried Uniswap and PancakeSwap. Would you count them as a dApp? Yeah, because they're DEX. And I thought it'd be quite interesting to compare Uniswap to PancakeSwap, because I know Uniswap came first, I believe, and that PancakeSwap, I think they took the code, I don't know if I'm correct in saying that, and made some adjustments. And so I was quite curious to see how they would feel different. And Uniswap felt very minimalist, I found, when I went on it. It was quite simple, quite dark. I always found it a little bit too dark. But PancakeSwap was very vibrant, and there was like a lot going on, but it was almost a bit too much. I found that it was like, it kind of felt a bit more like a gambling site. That's what I thought. So I thought that was a bit unusual. And on both of them, I have to say I was a little bit confused what I was doing, because I hadn't really experimented before. I found the swap feature straightforward, but the providing liquidity for the pairs was a little bit confusing, but I think I figured it out. Yeah. I did also try Aave, and I found that much more confusing than using a DEX. I didn't really know what I was doing. Like, I provided capital, and then I got this token, and then I wanted to borrow, but then I tried staking with it, and then I couldn't borrow because I'd staked with the token. So I think I was just a little bit confused what I was meant to do, but I kind of figured it out by the end. Yeah.
Thanks for sharing your experience. Did you take a look at their documentation, or did you?
No, yeah, that's the thing. I sort of just like jumped into all these different dApps and just kind of messed around, and just sort of see what would happen. Like, I didn't have a deep dive in any of the documentation. Yeah.
Got it. Thank you. You kind of touched upon the second part of my question, which was asking you about your experience while you deposited, what you thought of the UI, and whether anything was specifically helpful or confusing. Would you like to share more on what confused you on some of the UIs, Jonah?
I think there was, with some of them, it's like there's a lot of menus, and there's nothing that like walks you through it. Whether I found on like Web2 a lot of the time, if you're using a lot of websites, it really holds your hand through it. And it, like, I'm not saying that's good or bad, but for me, I would have preferred a little bit more guidance in this case, because I was just very confused what to do, really. For some of them, like the dexes, I found you go on the dex and it's like, this is how you swap, and it's really simple, which is nice. But then for the people who would want to be providing liquidity, you'd have to read the docs and try and understand it a bit more. So I think I can understand why they wouldn't want to guide you so easily through providing liquidity, because that's a little bit more risky. Yeah, that's just my thoughts on that. Yeah.
Yeah, thank you. I think we have seen some dApps that come with light UI versions where users are confronted with more minimal options, or more straightforward things to do. So yeah, that seems like an important piece of feedback. David, what do you think? I know that you have been around and had experience using some protocols beforehand. Do you have any notes to share on this note?
Yeah, sure. I find Morpho quite clear to choose a vault to deposit and to do simple yield. I wanted to do a single exposure. So I filtered the vault that are above 10 million of TVL. It was a very clear table. Then once I chose a vault, I could see the historical APY and the historical TVL for the past 3 months, let's say. So I could see that the vault was not too shaky. in APY or total deposits. There was a risk tab, but for the specific pool that I chose, which was a CB BTC, it was said not provided by creator, so I was a bit disappointed by that. But it was nice to have the tab anyway for other vaults. What I found unclear was two things. One is that I had to swap outside Morpho because I had a USDC. So I had to use, I used the co-swap to swap. So it was not integrated inside Morpho. For example, in Bifi, you can swap directly. So this I found a bit lacking. And the other thing, I had to do 3 signatures to deposit. So normally it's 2, it's 1 approval and 1 to execute a transaction. But here you have 3, you have 1 approval and 1 general adapter, they call it, and 1 bundle. So I didn't really understand why you have to do two signatures for execution. So
That's interesting. Okay. So overall, I guess. Oh, please go ahead.
No. Other than that, it was no real headache inside Morpho.
Got it. Cool to hear that. But I guess overall, we can say that it's much easier to use a protocol when you are guided through the usage. And that's something that we have been talking about in Nexus as well, to make sure that you know which steps are ahead of you and you can prepare yourself. One last question. How easy was it to purchase cover? David, maybe this time we start with you. I know.
Yeah, start. Yes, it was very easy. I liked a lot the trending when you select a protocol because I cheated. I didn't choose the essential cover. I chose the Morpho cover because it was trending. And as I was choosing Morpho, I said okay. And I didn't find any difference in the coverage if I choose a protocol. So maybe they should do like if you could a table to compare the coverage if you choose one specific protocol. I don't know, but was no worries. Just when I purchased the wallet, I use Rabi wallet, and it had low popularity. So I don't know. For me, OpenCover is well known, and you want it to be good. I don't know. Reliability on the wallet, but as it said, low popularity. If I hadn't known OpenCover before, maybe I wouldn't have interacted with the.
Oh, thanks. That's an important note.
Yeah, but I don't know how you can increase your popularity in Rabi wallet, but.
Yeah. Oh yeah, I think Brave was working with some of the teams that are in the intersection. Brave, are you here?
I am, yes.
Oh, cool. Do you know how Rabi's low popularity warnings work? David got one when he wanted to purchase cover from OpenCover.
I think it's depending on the number of people on Rabi that connect to the site. So.
Yeah. So it's just a number of people. Yeah.
Yeah. Cool.
Yeah, it could be there's more people using different wallets than Rabi on that site.
Okay.
Yeah.
Okay. I got you.
OpenCover says that look into it. Over to you, Jonah.
Yeah. I found it was actually surprisingly straightforward, and yeah, so I went as essential cover, and I could easily see all the protocols that I wanted to use, and I really like the flexibility for like I could choose the amount of coverage I wanted and the time period, and it was just like a lot more flexible than I expected, which I liked. My only thing was like the slider was sometimes getting a bit stuck, but when I refreshed my page, it like fixed it. So I don't know if that's my end or not.
We'll look into it.
Yeah, but yeah, it was really easy. Another thing is like once I bought it, I don't know if this is even possible on like on Web3 and DeFi, but I kind of wish I could see what protocols were covered, like in my wallet or something like that, because I had to like go back to the page as if I was purchasing it again to see what I was covered. That was just like a minor thing. It was not bad, but it's just like I feel like that would be something a classic website would have like made easier. Yeah. But yeah, apart from that, it was really good.
Thanks, Jonah. I agree with you. I wish we had that level of depth on our wallet. Wallet viewers. I'm not sure if we can do it. Maybe Brave has a better idea, but I know that we work to better integrate with different providers like Zapier and Zerion and all that. So thanks for the feedback, and thanks both for experimenting with DeFi and for providing feedback by purchasing cover. Stick around if you'd like to contribute to the open forum section. But now that we have Brave join us, we want to walk you through the lessons learned based on our claims history. But before we do, again, huge thanks to both David and Jonah. They have been very important parts of this cohort, and I look forward to collaborating with them further. Now, on to Nexus Mutual's claims history, which also tells part of DeFi's story too. Over to you, Brave.
Hey, everybody. Happy to talk a little bit about the claims process and the claims history. So when I got involved with Nexus in 2021, my first claim event was the Cream Finance hack. And to date, before that, we had two other claim events. One was for BZX in 2020, and then one was for the Urine YDI vault in early 2021. So we've had, several large-scale claim events since then, and our claims process has evolved quite a bit. But I want to point out that there's one major differentiating factor from Nexus Mutual and some other insurance providers and other coverage providers in DeFi, and it's that we were the first ones to offer on-chain cover, and our whole claims process is on-chain. So it's transparent. We'll talk about that as we go through the process here, and that's also available in our docs, and we have lots of resources around claims. But I think one of the most important things for people that are out in DeFi and are active, when there's a loss event, one nice thing about our claims process is all you have to do with protocol cover is sign a message or send a zero value transaction. And from there, because everything's on chain, we can actually look and determine what an individual's loss is as long as they can verify ownership of their wallet. That's been a very interesting process, especially as DeFi has evolved over time. There's been a couple larger claim events this year. There was one for GMX, and while we covered GMX, we didn't have any active covers for it. And then the Arcadia hack that happened just yesterday in the morning. That one, it's likely that we'll pay out claims for, but because they use sub accounts, that makes the claim calculation a little bit more complicated. And I'll talk about that as an instance in Euler Finance. But I think largely speaking, the claims history has been very helpful in further improving our products over time. We've paid out more than 18 million in claims so far, and that's been across protocol cover, some of the other subgenres within the protocol cover product type, and then custody cover. So I think one of the most important things is to understand what people's level of understanding is about what they're doing in DeFi and how they can provide proof of loss. The two claim events that we're going to talk about today are FTX and Euler Finance. FTX being an interesting one because we offered custody cover in 2020 onward, and then we paused it for a little bit before relaunching it. But with that one, that's a little bit different because we had to have off-chain proof of loss because we don't want people to expose their sensitive information. But because our claims process is fairly lightweight, we definitely work with claimants to help them calculate loss. It's been very impactful for people, especially in the case of FTX, which we'll talk about a bit more. But like I said, we've paid out over $18 million in claims. The claims process itself within the mutual for people who are actually filing their claim is about a 3-step process. You provide the incident details, you sign a message to provide proof of loss, you review all the details, and then you submit. And then from that point, after you submit your claim, Nexus Mutual members who have expertise in looking at the blockchain and assessing loss can get involved, and they do that by staking NXM. They stake NXM within the protocol. This is separate from any NXM that might be staked in a staking pool to underwrite risk or elsewhere. This is capital that assessors are putting at risk while they're assessing claims. So if there is some kind of fraudulent behavior, that NXM is at risk of being slashed or burned completely. If somebody is trying to deny a legitimate claim or try to push through an illegitimate claim. So we have that fraud protection, which has worked very well as long as the mutual has been around now, which has been 6 years since we launched in 2019. We've had actually one event where somebody voted fraudulently on a claim. They tried to approve an illegitimate claim where no loss had happened on Kraken. And they had their NXM burned. So other than that, we haven't had anyone try to push through an illegitimate claim or deny a legitimate one since then. But assessors look at all the information. They look at this information that claimants provide when they file that initial claim. They verify that a loss has actually occurred, that cover was active when the person suffered the loss. They go through and they make sure that everything is valid from our side, that it fits within the covered terms within the cover wording. And if all of that checks out, then claim assessors vote on that. The claim is typically open for somewhere between 3 to 5 days, closer usually to that 3-day mark. And then a claim closes. There's a 24-hour waiting period. That's when the advisory board can check and make sure no fraud has occurred. And then after that, if a claim is approved, then the claimant can go in the UI and they can withdraw their claim payment, and then they're made whole. So it's a relatively lightweight process. The bulk of the claims that we've paid out actually happened in 2023, and you can see on this slide a chart of the claims that we've paid over time. We paid a good number of claims in 2021, a large portion for the urine wide eye hack. We paid about 400,000 out for the cream loss event, but the largest claim events we've paid out for to date have been the Riri Capital hack that happened in 2022, the FTX halted withdrawals and Holdenut halted withdrawals, which happened. The original loss was at the end of 2022, and then claims were able to be filed 3 months after withdrawals were halted. And then the Euler Finance hack, which happened in March of 2023. So if you look there, you can see, the bulk of our payouts are at that time. And then in 2024, we had a few payouts for OpenCover's transaction cover. And in 2025, we haven't had any claims paid out to date. But again, that's probably going to change here in a couple weeks when Arcadia claimants can file their claim. So that's kind of an overview of this process. I did want to talk a bit about some of the case studies, some of these larger loss events that we've had. So one is FTX, which I'm sure everybody is very familiar with. FTX has been talked about by everybody at length. So ultimately, the loss here was because the folks behind the FTX exchange were not managing money responsibly. They invested in a lot of illiquid things and did many illegal things, which some of them are now in prison for. And because of that, they did not have the funds to honor withdrawals when there was kind of a bank run on the exchange. And because of that, because they had mismanaged funds, users incurred a loss. And that FTX bankruptcy process started, I think it was marked from sometime in November of 2022 onward. And it was just this year that FTX bankruptcy claim payouts happened. And in that time, there's been, a big change in the price of crypto assets. But for those who held FTX custody cover, they were able to file a claim. We had 27 members who were impacted by this. We had 24 claims that were paid out. There were a few members that bought cover after withdrawals were halted, which, of course, if you buy coverage after a loss event occurs, that's something that we can honor. But for individual claimants who filed claims who had bought cover before withdrawals were halted. We were able to pay them out and make them whole. We paid about a little shy of $5 million up for this, so more than $4.9 million in claim payments. The trigger at the time for custody cover wording was that withdrawals had to be halted for 90 days or more for whatever reason. So after that occurred, we allowed people to file claims. In the interim, like I said, for the proof of loss for custody cover, we required people to send us information about their holdings on the FTX exchange, which we were able to verify. So for every claimant who submitted their claim information and details, we had them send us the off-chain proof of loss so that we could verify that while ensuring their privacy was still in place. We don't want to expose anyone's public information or share anything about that publicly because that's sensitive information. But the advisory board members were able to confirm that information and then share that with members who were assessing those claims. One of our largest claims, which is on this slide here, was claim 157 in V1 before we switched over to Nexus Mutual V2. This member purchased cover, I think, just a few days before withdrawals were halted. And then they were able to submit their claim on the 6th of February, which is just, I think, a little bit after we opened up claims filing. So they filed a claim for 1.15 million. They had a pretty sizable amount of holdings. And if I remember correctly about this claim event, they had a little bit more on the actual exchange, but this is all that they had purchased cover for. So we looked at their information. We calculated their the value of their balance holdings at the time withdrawals were halted. We let claim assessors know that information. A lot of those discussions happened on Discord, and we've summarized that in the Nexus Mutual claims database, which you can find on our DAO website. So members were able to verify the proof of loss here. They voted on this. In this case, in V1, we had a little bit of a different process for assessing claims. You had to meet a certain quorum for a certain amount of NXM had to be used in voting weight to assess a claim for individual assessors to approve a claim. That quorum wasn't met, so then it went to an all member vote. We don't have that process anymore, but that was the case here. So it took a little bit longer than that typical 3-day mark to have this claim approved. But that being said, their claim was approved, and that claim was paid out on the 13th of February. That's verifiable on chain. You can see when that was paid out. And this person was able to get paid 90 days after withdrawals were halted instead of having to wait several years after the exchange went under to get their claim payment. I remember this person had reached out after and was very, very happy and thrilled with the product. So we did save quite a few people a major headache during the FTX implosion, and there were other people that wished that they had purchased cover at the time. But these claim events are always very hectic. That one in particular was very hectic because if folks remember the FTX website, their exchange page was hacked, and so that website was no longer available. So a lot of folks had to go through Kroll to get the information necessary to provide proof of loss for that claim. But that one was the second largest claim event that we had, with the first one being the Riri claim payouts. And then it was very shortly after we had these FTX claim payouts that there was another very large hack, which was the Euler Finance hack for their V1 in 2023. So this hack was caused by a vulnerability in the smart contracts. In the case of Euler, they were audited, I think, more than a dozen times. They had a very large bug bounty. They had done all the right things from a security perspective, but they had a rather complicated protocol. And there was a logic error that allowed somebody to come in and basically borrow the vast majority of the assets on their lending protocol. And they were able to drain pretty much nearly all of the funds in the protocol. And Euler did something similar to what Arcady does, and what you'll see a lot of protocols doing now is they used a kind of abstraction to have sub-accounts under one main account. So people could open up multiple positions, and they could take out leverage on one particular position against a certain amount of collateral, and then they could have different settings for that sub-account versus assets held in another sub-account. This made for a very fun time when actually calculating loss and assessing claims. But this claim event affected 10 members. One of the claimants purchased cover after the loss event occurred. We had 9 individual claims that were paid out for this one, and we paid out a total of 2.4 million in claims paid to individuals for this hack. So this was, I think, one of the most talked about exploits of that year. Talking about an individual claim in this case was another rather large claim that we paid out. We cover this on the next slide. And this large claim that we paid out was for $1.56 million. In this case, this person, I think, had 2 main addresses with multiple sub-accounts. I can remember they had a lot of very active positions on there. I think, if I remember right, they had somewhere about 20 sub-accounts between the 2 core addresses when assessing this claim. So it was a very complex one to figure out because people were borrowing against their assets. And when you're looking at a lending protocol, you're looking at the collateral deposited, that value, less any debt that somebody had. And so that's how you figure out what that total loss amount is. So after we had calculated that, this person had provided proof of loss on both those addresses. They had gone through the whole process. From a claim assessment point of view, I, as well as a few other claim assessors, were able to verify that this loss had occurred, that their cover was active at the time, and we were able to pay out that claim. And that was $1.56 million in DAI that was paid out to them. This claim was filed on March 20th, and that claim payout happened on 25th. So you've got basically 3 days of assessment. There was that closing period of 24 hours when the AB checked for fraud. And then the day after that was the 25th when this person was able to withdraw their claim. So basically in about 3 or 4 days, everything was wrapped up here and this member was able to withdraw their claim. This person was also very grateful. I mean, all claimants are very grateful that they had cover and that it paid out. But I also helped a lot of people calculate their loss in this case. What happens when FTX paid after a few years? Yes, so in our cover wording, we have reimbursement language. So if you buy cover and you suffer a loss and we pay out a claim, and then in the future there's reimbursement, what we do is we work with claimants and they can, for the FTX, in the case of FTX, they assign over their claims. And so we were able to get some reimbursement for some of those claims by going through the bankruptcy process. So they got paid up front, and then we were able to make some recoveries after the fact. I believe there are still some claim payments that we're expecting, but we've gotten a bulk of the funds back from those bankruptcy cases that were assigned over to the mutual after the fact. But that's how we have it in our wording as well. If there is reimbursement, then that comes to back to the capital pool, everything, and we can make some kind of recovery. But yeah, so that's a summary of our claim events. If you'd like to learn more, you can check out the information that we have on our docs. We have that claims database, and happy to answer any questions that anybody has after the fact as well. But I will pass things over to Hugh to talk a little bit about the updated roadmap for Nexus Mutual.
Cool, thanks, Brave. Yeah, so just wanted to give you a little bit of an update about where we're at and where we're going next. So conveniently, I've just put out a governance post yesterday, kind of outlining a lot of these points, but I'll quickly run through them here. I think one of the things is, in terms of like where we are in general, I think we've done really well as a mutual, kind of being there first, proving ourselves that the system works, that we pay genuine claims, that we can be there when things blow up and we're still around. I guess a lot of the other kind of DeFi or on-chain coverage protocols aren't there anymore, but we are, and we've continually proved that. And I guess we've also been kind of trusted by the big funds in the space, and the bigger kind of more serious users definitely use us extensively. And so we've kind of built up this I guess really solid reputation and trust amongst the kind of power users of DeFi. And kind of, to me, that is a really good spot to be in, as it sets the ground or base level for what I think hopefully is going to happen next. And that's where I believe we're set up well for the next wave of capital and users to come into DeFi, and I guess into crypto more generally. And so I think the next wave of users is going to be kind of two important things. One, it's going to be a lot bigger in terms of quantum and value coming into the space. But two, they're also going to be a lot more risk averse than the current users within DeFi. A lot of the current users are very much risk on. They're kind of looking to make lots of money pretty quickly, and they're willing to take quite a lot of risks to do that. But the next wave of users will be much more risk averse. So not only are they going to be a lot bigger, they're going to be much more risk averse, and so therefore the need for coverage or insurance or whatever it is, protection is or risk management more generally is going to be a lot bigger. There's going to be a wave of this multiplier effect, and so I think those two things together being we're very well positioned and built up a lot of trust over the years, and secondly the large wave of users coming in, I think kind of the base level kind of high level points that we kind of need to address or set the strategy and what's next for Nexus. So that's kind of the key thing. So what does that mean we do? There's a few other points, and please dive into the governance post, but those are the two really big ones. I guess there's a few things that I believe that we really need to do. One is I think we can make some tweaks to the claims mechanism to kind of build on that trust. And you can go through the details there, but I think the claims mechanisms has worked generally really well. But one of the things that kind of struggles is because it's open to any member to vote on claims, that kind of introduces doubt into kind of more serious players, I guess, minds when they're working out, can I trust this mechanism? And like that, the whole typical thing or feedback we get is random DAO voters might impact my legitimate claim, and how do you guys prevent against that? Whereas the fact of the matter is it's a self-selected group of experts that are actually voting on this claim, and it's not really a functional concern, but it's not easy to say, well, no, that's not going to happen, because there is a potential chance that it could, even if that's very remote. So the way I think we should reform the claims mechanism is to essentially have a delegated model where you delegate to specific expert groups that could be different by product line, and then you can kind of say, look, these are the experts, they've got history, they know what they're doing, etc. And I think that's a better way to build trust. So that's kind of point number one. Point number two is, sorry, I'm scrolling through my notes. But point number two is work on our governance contracts, and I think this is a bit tangential, but we need to really simplify the governance contracts from a security point of view, and make sure that they're kind of robust and scalable. And people, you can read the detail in the forum, but I think essentially what we're doing is we're using an optimistic governance approach at the moment, but in actuality, but it's not really set up that way. And if we did set it up that way, we'd simplify things, we'd streamline it, and everything would work a lot better. And I think if you think about this from a higher level point of view, essentially what we're doing is the members are delegating responsibility to the advisory board to run things as they see fit, because they're the experts. But they always retain control to kick the advisory board members out at any time, and that can't be stopped. And so there's this kind of we'll trust you until we don't like it, and then we can gain control back. And I think that's a very important way of doing things. Otherwise, the other approach of just not doing anything unless everyone votes can lead to challenges about actually progressing, and it doesn't allow you to move as fast as sometimes you need to, especially when we have such a kind of, I guess, expert type protocol. It's a relatively complicated protocol. There's lots of things to balance with risk, with exposures, with product wording, with the mechanisms of the protocol. It's all quite complicated, and so I generally believe that's better delegated to an expert group. But always retain the control of the members. That's one of the most important things. So that's kind of number two. Number three is a really exciting one, and to me, we're at this point where we have a discretionary mutual model. which is a non-regulated insurance, but we're also getting usage by customers that some of them may prefer a regulated insurance contract. And so how do we actually work out how to bridge Nexus Capital and effectively wrap it in a regulated insurance contract? And up until now, that has been very challenging. We've explored lots of ways to do this over the past 3 years, and it hasn't really been able or possible. But now with regulators moving and approving things with other players that they haven't approved before, and also us working out a way that we can do this without essentially kind of breaking what Nexus Mutual is at its fundamental core, an on-chain risk protocol. We've worked out what to do here and how to do it, and we think it's worthwhile proceeding. And this, assuming we get approval by the appropriate regulators, would allow staking pools within Nexus to become regulated themselves and therefore sell regulated insurance using the Nexus Mutual protocol. And I think that's pretty exciting as a way to kind of move to Nexus being a marketplace for risk and accessing many more markets within crypto, outside crypto, etc. So this could really set us up for a lot of growth as it can access as we would be able to access the trillions of the huge markets in the regular insurance world. So keep an eye out for that one. We definitely need a little bit more detail before we start specifying the protocol changes actually required, and we need engagement with regulators. But really excited about this one, and kind of looking to come back to members with a bit more detail about exactly what we're planning to do. So that's kind of number 3. Number 4 is more on the capital and protocol side of the mutual. For those of you that are in the weeds a bit, we have this mechanism called the RAM, which is ratcheting AMM, which is is the kind of mechanism with which the mutual, you can contribute capital to the mutual. So you contribute ETH in return to get NXM, and you can also go the other way. So burn your NXM and get ETH out. And so it's the mechanism with which the mutual does that. At the moment, the RAM's been live since November 23. It's added significant value to members, over about 15 million or something. I can't remember the exact numbers, but quite a lot of value to members and to long-term aligned members. But the one thing it hasn't quite done yet is enable capital growth of the pool. And so what we want to do here is twofold. We want to enable capital growth of the pool, but we also want to increase the amount of NXM staked, because the NXM staked is the NXM that's actually backing covers to encourage more growth. And so we want to do those two things. And what we're proposing here is that instead of the RAM value add being kind of generally spread amongst all NXM holders, if we isolate that value add and just allocate it effectively to the NXM stakers directly, that will encourage more of the activity that we really want. It will increase yields for staking, and it will hopefully also attract capital to the mutual and get us back on that growth path, which we are going to need to support the cover growth coming from various things, just generally more people entering the space, but also the traditional market bridge that I was talking about before. So those are kind of the 4 main items I want to put forward in terms of where we want to go on the protocol changes, etc., that are going to be required. Really looking forward to people's comments on this stuff. Some of those are very specific and well defined. Others are a little bit more vague at the moment, but wanted to get them all out there to start the discussion amongst the broader community. So yeah, dive in, have a look at that if you've got a chance. Really looking forward to your comments. Sam, I'll hand that.
Thanks, you. Check out forum.nexusmutual.io and look for Hugh's recent post in governance discussions for more information. All right, I will take the next minute or so to talk about our plans for the next cohort of the learning group, and then we will close the call after an open forum section. If you have missed this first cohort, where our cohort members learned about DeFi in a peer-to-peer manner, read about DeFi and discussed and experimented, you don't need to worry, because another cohort is coming soon. We're going to launch it in autumn. We're currently detailing the criteria for the application process and the priority selection. Also for the blockchain risk working group, which works on mapping on-chain risk with OpenCover and further initiatives that were born out of this learning group. Even if you can't make it to the live program and do the challenges with us, you can still follow along. All materials will be public, like this one. You will find your way very easily. We are currently getting feedback from some of our cohort members like David and Jonah, and are going to refine the program structure, the format. We'll probably have more partners that present their view and expertise on DeFi as well. So yeah, remember to stay updated if you're interested. You can join the waitlist already at nexusmutual.io/risk-group. I will share the link again on our socials, and we'll let you know once we have more information and details on the program. All right, we have 7 more minutes. If you have any open questions, David and Jonah, or any feedback to us, we already had some private sessions with some of the cohort members and learned how we can improve the experience in the next one. But I want to set the stage up again in case you have any more feedback to share as well.
Yeah, I can start now. Just I want to say in general, like the content was very, very good. Like for the first run, all the courses from Brave and from you, especially Brave, the introduction was very, very good. It was very nice. Just as I told you, the rhythm is a bit slow. I think every other week. I don't remember what we learned from the beginning. Right now, it's been 2 months, so yeah, a bit more than 2 months. But otherwise, yeah, very good, very good.
Thanks, David. I also feel like weekly is a maybe better routine when you can get into it. So yeah, definitely noted. Thank you.
Yeah, I think I'd have similar feedback really, but yeah, I did enjoy like the depth of technical expertise. That was good, and I'm looking forward to the second group. See what it's like.
Thanks both. We'll make sure to remember all your feedback that you had also shared privately. And thanks again for being a part of this cohort. Let me check the chat to see if we have any more questions. We have OpenCover, exciting times ahead. That's true. In autumn, we'll also have the public launch of our on-chain risk map, which maps the risk on-chain for all DeFi users and makes it clearer for all of us to understand risk and to stay safe. So definitely exciting times ahead. I see that there are no more questions other than this beautiful remark by the OpenCover team, and I think we're ready to close the call. Thank you so much. Thanks everybody for following up with us on this peer-to-peer learning journey. It was a pleasure interacting with you, responding to your questions and discussing DeFi. I hope we get to see you some more in autumn when we are back again. Until then, have a nice and safe summer and see you soon. Bye.
Thank you. Bye.